In this month's market update, the government shutdown is over, and we have new unemployment data. We're going to dive into what this may mean today.
We also have the October existing home sales report, and we'll go through some interesting stats from the most recent survey of home buyers and sellers.
And the Fed will meet next month. Will they cut or will they not?
All that and more on this month's market update.
Welcome to this month's market update. I'm Gabi Brennis-Holz, and I'm joined by my co-host today, Ruben. How are you, Ruben?
Good. How are you, Gabi?
I have been very well the last 4 weeks, and a lot has happened over the last month.
Yeah, a lot of news.
A lot of news. Today, we're going to dive into some of the unemployment data that has been released now that the government shutdown has come to conclusion. We're going to talk about some NAR numbers, and we're also going to dive into the Fed meeting coming up.
Yeah, with some big things coming up on the horizon.
Yeah, absolutely. Let's start with unemployment.
Yeah, so we still don't have October numbers, but we did get the delayed September numbers because essentially when we went into the shutdown, they'd already gathered a lot of that data. It was kind of sitting there waiting to be compiled and put into a report. Government shutdown, that didn't happen. So we did see that unemployment actually ticked up slightly to 4.4%, continuing its upward trend, right? So on one side of things, we have the Fed looking at that probably and thinking, not so good news. But it actually surprised to the upside when it came to the number of jobs added. So we actually added 119,000 jobs that month. Most economists were expecting only around 40,000. Some good news and some bad news. It's kind of interesting because when you look at it, you can kind of sit there and say, well, depending on who you are on the Fed board, you could view this as supporting your decision to cut rates or supporting your decision not to cut rates. Some good and some bad news. The rest of the stuff that came out, so we were also finally again seeing a weekly report called the new claims and continuing claims data. So that essentially shows like how many people applied for unemployment this month and how many people are still getting it carrying over from previous months. So the new claims data was relatively flat. That's good-ish news, basically meaning that like about the same amount of people applied this month as did last month. Those numbers are a little over 200,000 people right now, or per week, I should say. The more interesting figure right now is that we're actually seeing an increase in the continuing claims. So even though we have about the same number of people applying, the number of people that are kind of like trickling out of unemployment into the labor market is slowing down. So we actually saw that number at the highest level since November 2021. So again, we're getting into this, is the economy in the labor market in particular, is it fine or is it deteriorating? So that's going to be a lot of the debate when we start talking about Fed policy a little bit later in the show. There's two sides of both of these views of the data that's coming out right now. And with the next Fed meeting, we won't actually have the October or November data yet when the Fed meets because the release, which normally happens on the first Friday of the month, has been delayed to like the 16th of December instead of earlier. So the Fed will actually meet on the 9th and 10th. So they'll be going in with less data than they were originally anticipating, even without the government shutdown. So
what do you anticipate will be some of the data points that they will have to take into consideration?
I mean, I think we'll definitely see them. Inflation data is going to be coming out as well. Anything that's pointing to the labor market is going to be important. Those are always the two key factors for the Fed. They have a dual mandate. So what's happening in the labor market? What's happening with inflation? Those two things potentially are moving in opposite directions right now. We've been having that conversation. So that the Fed's basically in a split decision kind of situation right now. So we'll see what that's going to look like. And that's most of the new data we've gotten out so far, right? Like we've just now come out of the shutdown. We've gotten our first BLS report, and it's sort of this lukewarm but better than expected in some ways information, but it's already old data, right? We're talking about September. We don't have October data yet.
It almost sounds like cautious optimism.
Yeah, I think that's where it is. People are looking at that and saying, okay, 2 months ago, we were a bit better than we thought we had been, but what does October look like? What does November look like going into this? So, and we won't know until after the Fed meeting. So, we'll get together next month and, we'll be filming this after that Fed meeting. So we'll have more information then and be able to go through some of those numbers.
And the numbers that we are seeing as it comes to unemployment have an interesting correlation as it also came to the numbers that NAR just released.
Yeah. So, I mean, we know that, when people start feeling a little bit nervous about the labor market, they also feel a little nervous about making big purchases. So when we look at NAR statistics last week, we saw home sales were relatively flat. despite the fact that mortgage rates are a little better than they had been earlier in the year. So to go through the numbers, October existing home sales were 4.1 million. That's about a 1.7% increase from the previous year. We saw inventory tick up about 11% year over year. We're at 4.4 month supply. In terms of month supply, that number tends to peak right around August, September, and then it tends to trend down for the rest of the year as, just normal seasonality kind of kicks into when people are listing their homes. So we expect that to continue, and then we'll see that pick up again in the spring. In terms of prices, 2% nationally, we saw prices go up to $415,000 in terms of median prices for NAR. Split across the country again, right? So we're seeing prices being flat in the South and the West, both at essentially unchanged prices from last year, but up in the Northeast and Midwest. So Northeast still leading the country, 6.5% year over year price appreciation, and the Midwest at 4.6% just behind them. Tale of two markets in a lot of ways, right?
Mm-hmm. Absolutely. Absolutely. Where do we think the market is going to be headed knowing this?
I think right now we're looking at much of the same, right? Like we're going to see interest rates, we think, continue in the low 6% range unless something dramatically changes, which, we don't see anything like that happening on the horizon right now, but you rarely see it coming.
Mm-hmm. And it continues to have an impact on the types of buyers that we're seeing in the market too.
Yeah. We were just chatting earlier, right, about kind of some of the surprising data that's in that NAR survey of home buyers and sellers. One of the first things that jumped out to me was the fact that cash buyers set an all-time high. I think that's a reflection of affordability, right?
Yeah.
People are basically foregoing a mortgage entirely more frequently, or investors are higher percentage of participants in the market right now because of affordability challenges, right? Mm-hmm. Another thing that I think is also a reflection of the same statistics is the fact that the first-time buyer age was ticked up from already being at an all-time high of 38 in the last survey up to 40.
And that was just over the last 6 months because we talked about it in our February and March podcasts. And here we are just a few months later. And that average buyer age is 40 years old.
Yeah, so this number is continuing to trend up. And we think that, again, is a reflection of the fact that younger people haven't had enough time to save up these bigger down payments. They're less likely to have incomes that allow them to qualify for mortgages at the current home prices and interest rates. So a lot of that affordability issue is essentially pushing the age of who's participating in the market right now up.
Including the repeat buyers too.
Yeah, so it's across the board, right? So the average repeat buyer right now is 62 years old. So, we're seeing, again, an increasing concentration of people with more mature finances being more likely to be able to participate in the market right now. So that's basically causing the age of the first-time home buyer and repeat buyers to be higher than it was historically.
Yeah. And of course, the down payments will have a correlated impact on this as well. We have never seen that the average down payment is as high as it has been sitting at around 10%.
Yeah. So for first-time home buyers, it's at 10% right now, which is essentially tied with where it was when we started this survey, which was in 1989, when NAR started doing it, which we know interest rates were where they were basically coming off of some of the highest interest rates. For repeat buyers, that number has trended up to 23%. So, 20% is sort of what do you think of standard? The fact that it's averaging higher than that tells me there's at least some portion of buyers that are choosing to put down more in order to, reduce their monthly payments, most likely when they're borrowing against these mortgages. So it's interesting. Like affordability is very visibly impacting the shape of the market right now in terms of how people purchase their homes and what people are able to.
Mm-hmm. And it's good for real estate professionals that are listening to our show to notice this as well, because the way that you end up positioning and having consultations with buyers who might be curious about what the advantages might be in this season's market, this will have an impact because if previously we may have consulted buyers to think about down payments that were in alignment with FHA loans or with conventional products that could demand less than 10% based on the mortgage product, they may not be competitive if having a certain mortgage payment is their goal.
In general, it's a challenging market, especially for first-time home buyers. So having strategies in your pocket to help them, I think they're looking for more explanation than ever. It's not a simple market to operate in right now. I was literally just having this conversation with my younger sister of explaining like what are points on a mortgage, like what happens when you buy a point. Can you get a seller by a point? Like she was, most people don't spend their daily lives thinking about those kind of things. It's not something that's like a piece of information they possess before they go into the home buying process. So I think there's a huge amount of value of like educating people right now.
Absolutely.
I think there's a lot of people on the fence, right?
Yes, yes. And we see this in the data of when we talk to real estate professionals across the country. In the past, an easy way to think about when a buyer might have the first consultation with a real estate professional to the time that they were going under contract on a house used to be around 90 to 120 days. That's what we called the buying cycle. And now what we're seeing across the country is that buying cycles might be somewhere between 160 to 180 days. So as we're thinking about, the buyers that we're servicing coming up, we might be talking to someone today that may make a transaction next summer once the kids are out of school, partially because of the motivation or the perfect timing in their lives, at which point they might want to make the transactional move. But also, on the other hand, because folks may need longer to save up for that down payment.
Yeah, I think that's part of it. And we're also just moving into a market, right, where like buyers have more choices. And we know that when people have more choices, they take more time to make decisions. And I think that's also a thing. Like, we're, for the first time in basically a decade now, back in a position where in a lot of places buyers can take their time, they can be picky, they can go see 20 houses if they want to before they make a decision. Where, a handful of years ago there were people having to make offers on houses before they even saw them, right, to even have a chance. So the market's meaningfully shifted. I don't know that a lot of first-time home buyers understand how much that's shifted. I think they aren't necessarily aware of the negotiating power they have, of the number of options there are on the market. So I think that that's a tool that people can use to probably find some first-time home buyers that could be in the market that are kind of working off the assumption that homes are as expensive as they were 2 or 3 years ago. It's not true in every market now. We have, if you're in the South and the median home price is only up 0% year over year, right? That means that probably half of markets or of homes that are on the market are basically showing decreases year over year, right? So there's opportunity, I think, to be found, but it's a time where people need to be educated.
Yeah. And it's also an interesting point of education for someone who might be thinking about putting their property on the market in the season. Because let's think about this. If you have buyers that need to have more time for a down payment, that may also mean that those buyers may not be in the market to purchase a house that is not in good to great condition. So as a seller, you might want to think about either pricing the property competitively if you know that the property will need repairs, or that the property may need to be fixed up prior to hitting the market so that it can show in excellent condition, because those buyers in certain price bands may not have the means to be able to fix up the property on their own.
Yeah, I think that negotiations around everything right now are shifting, right?
Yeah. And we alluded to that in last month's show as well. Let's dive into the upcoming Fed meeting.
Yeah, so, we kind of hinted at it a little bit earlier. Really, the baseline story here is that this is one of the first Fed meetings in quite a while where we don't really know what's going to happen going into it. There's very little certainty around, do we get a 25 basis point cut or do we hold steady in the next month? Right now, a lot of, futures markets and things like that are putting in almost a 50-50 chance one way or the other. And we're seeing communication come from Fed presidents, board members, that on both sides of the spectrum in terms of, the labor market hasn't really moved meaningfully yet, so we don't have a reason to cut again, to others seeing things like continuing unemployment claims we were talking earlier and saying like, hey, that's a sign of weakness in the labor market. We need to continue to get ahead of this, cut 25 basis points. Opinions are starting to differ a little bit on like where inflation is. So this kind of lack of data we've had for the last 2 months, the fact that things have kind of stabilized in an interesting place, has led to a point where we're going into a Fed meeting with some uncertainty.
What do you think this will mean for interest rates?
So in terms of mortgage rates, it really just means increased volatility as we head toward that meeting, right? So markets aren't able to fully anticipate the Fed decision. So it means that this is one of the meetings where it's almost certain that once we get a decision from the Fed, rates will move one way or the other. So if we see the Fed cut rates, that means that rates may drop a few basis points, maybe like 10 basis points, maybe more. And if they don't, we may see rates jump a little bit. Same ballpark. So I think in this case, we're definitively likely to see rate movement on the day of the Fed meeting, unless we start to see some consensus build in the lead up to that meeting that we haven't seen so far.
And speaking of mortgage interest rates, we have our first question from one of our viewers. And Zach has asked us, hi, Gabi and Ruben, could you talk a bit about the 50-year mortgage? Do you think it will be approved? How would that impact the market, home prices, etc.?
Yeah, so quite a bit to say about that. Let's first look at like some numbers, right? So I'll open up my laptop here so we can see. So basically what this is if you take your equity when you sell your house, right? You take whatever you sell your house at minus the balance of your loan at that time, you get equity, right? Well, we then subtract out the total amount of interest you've paid on that loan from that equity to see what is your, we'll call it net equity, or your return on investment on your home basically after time. We've done that for both a 30-year mortgage and a fixed-year mortgage. So just to run through the assumptions, $450,000 price, 6% interest rate, so ballpark where we are now, 10% down payment, so we saw the average first-time home buyer payment right around there, and 4% appreciation. So, when we talk about long-run appreciation for a home, we usually talk about 4%. It's a combination of assuming like basically 2% inflation plus 2% real appreciation on homes. All that baked into here. And you can clearly see like an interesting feature of the 50-year mortgage is that your return on investment is actually declining for about the first 7 or 8 years of owning the home. And, when you look at that number, your, net of your interest at 7 years, which is not far from when the average people move usually their first time after owning their home, you're only net positive about $8,000. Well, after you pay your fees, all the commissions involved with selling your home, you're talking negative ROI now potentially with that 50-year mortgage. And just the gap over time, you're going to pay on this home, I believe you pay $400,000 more in just interest over the lifetime of the loan than you would on a 30-year mortgage. And it's interesting because, we assume the same rate for both these loans, but, tell me this, Gabby, which has a higher rate, a 15-year mortgage or a 30-year mortgage?
Right.
The 30-year mortgage, right? So why would a 50-year mortgage have a lower or even the same rate as a 30-year mortgage? It's going to be higher, right? Because the longer the time period of the loan, the more risk to the bank, the more the bank wants into return. When you look at the math on these, and to get into the payment issue, this only lowers your payment by about $300 a month on this loan. So not to say $300 isn't meaningful, but when you take into account $300 in the context of paying essentially for the home a third time over the life of your mortgage in terms of like what you're paying in interest, the math just doesn't really math here in a lot of ways, at least with a traditional structure to this, unless there's some kind of kooky special thing that's going to be baked into this that has not been explained to us. I don't think these have a lot of viability as a financial product right now with the way mortgages work in the world we exist in.
It would certainly become difficult to build meaningful wealth if we know what the average buyer is doing throughout the life of transacting every 8 to 10 years, if we know this is the math.
Yeah, like the challenge is to some extent, it's almost like you end up renting from the bank instead of from a landlord.
Yeah, certainly not a way to build wealth. Yep, it's a great question, and we appreciate that those questions will continue to come in, and we'll be eager to continue to answer them. And I think it's safe to say that Ruben and Gabi, and as it comes to yay or nay on the 50-year mortgage,
nay.
We're a nay.
Yeah. So I guess final thoughts, let's wrap it up. We started with unemployment data. It's, a little bit hit or miss on whether it's good or bad. Basically, it's essentially just not enough recent information to give us a good sense of where the Fed's going. We saw home sales were essentially flat. Prices were flat for most of the country other than the Northeast and the Midwest. A little bit higher inventory than last year. And again, the Fed meeting is a little bit of a coin toss as we go into December, and we think it's likely going to move mortgage rates a little bit, when we get a decision.
Mm-hmm. Ruben, thank you as always for your expertise. And thank you all for listening today. Please remember to click like and subscribe, and we'll see you next month.
See you then.